Welcome to this presentation on delta hedging of securities portfolio. Here would be covering the following areas pertaining to delta hedging. Introduction to delta hedging, methods of delta hedging, dynamic versus static hedge, concept of replicating portfolio in hedging, need for delta hedging, benefits and limitations of delta hedging, and all the related areas pertaining to all these fields and pertaining to delta hedging. I am Aninda Datta, the presenter. Now, what is delta hedge? Here we'll consider mainly here we'll mainly cover delta hedge in European options, but delta hedging could be done in American options also. However, the formula for delta hedge is delta is slightly different in American options, as this could be exercised anytime. All the principles of delta hedging are similar in American options also. Now, what is hedging? Hedging is an advanced risk management strategy that involves buying or selling additional securities in order to reduce the potential loss of an existing position of securities. Now, what are the various risk exposures of an option and which risks are generally hedged out? Directional risks from price movement of the underlying asset is the biggest risk to the option price, and it is measured by delta. This risk is generally hedged out by the traders. Now, volatility risk from change in volatility of the underlying asset. Now, this risk is measured by Vega. This risk is also hedged out by most traders. Now, time value risk, that is the risk from reduction in time to expiry. This is measured by theta. However, this is a certainty as time value always reduces, so this is not hedged out. Now, risk from change in risk-free rate of interest. This is measured by rho. This is a very minor risk, so not hedged out. Risk from change in underlying dividend rate, not measured by any risk, so cannot be hedged out. Thus, delta hedging is a strategy whereby the directional risk associated with price change of the underlying asset is hedged out by buying or selling options. Here we will examine various methods applied in delta hedging and difference between dynamic and static hedging. The sign of delta is the direction indicator. Positive delta means long on the market, that is value of the portfolio with positive delta increases with increases in market price. Negative delta means short on the market, that is value of a portfolio is with a negative delta decreases with increase in market price. Now, what are the securities with positive delta? Long share, long call option, short put option. Now, what are the securities with negative delta? Short share, long put option, short call option. A portfolio with positive delta is hedged with security of negative delta and vice versa. Now, based on frequency of portfolio rebalancing in the course of hedging, a hedging strategy could be divided into two categories, that is dynamic hedging and static hedging. Now, what is static hedging? Here the investors do not actively rebalance the portfolio every time the portfolio delta changes due to change in price of the constituent securities. Now, what is a dynamic hedging? Here the investors actively rebalance the portfolio every time there is a change in portfolio delta due to change in price or any other factor. Now, what is the concept of replicating portfolio in the concept of hedging? When cash flow of an asset or portfolio is matched by another set of assets or portfolio, then it is called the replicating portfolio. Hedging is carried out by an offsetting replicating portfolio. That is, a portfolio's reaction to change in a risk factor is exactly the opposite to the reaction of the main asset. Under delta hedging, price change of underlying is the risk getting hedged out. So replicating portfolios should have exact opposite reaction to price change. Now let's examine delta hedging of an option portfolio. Delta of long call is given by ND1, that is the cumulative probability distribution of D1, and is a curve along the underlying asset spot price axis. The delta of a long call option varies from 0 to 1. The delta of a short call varies from 0 to -1. The delta of a long put option is given by ND1 -1 and is a curve along the underlying spot price. The delta of a put option varies from 0 to -1. Delta of a short put varies from 0 to 1. The delta of a long share security is 1. That of a short share is -1. The delta of an option varies with both time and spot price, so just passage of time may require rebalancing of the portfolio. Now, the delta of a portfolio is linear combination of the deltas of the individual shares and options constituting that portfolio. Now, suppose an investor sells at the money call options having delta of approximately -0.5. Then to create an offsetting replicating portfolio, the investor needs to long 0.5 shares for every call option sold. However, the delta neutrality of portfolio would be maintained only over short range of spot prices. So to maintain delta neutrality, dynamic hedging strategy needs to be followed by altering the number of long shares with change in spot price, that is by changing the hedge ratio. Now let's see how a dynamic delta hedge is constructed. Suppose a market maker has sold 100 call options having details as given in the attached box at a strike of $100. He hedges the directional risk by buying 58 number of underlying securities, that is having a hedge ratio of 0.58. The option price box on the below right shows the details of the call options being considered. The graph shows the call value and delta values of the call option at different spot prices. The first table shows the number of long shares needed to hedge out the short 100 call options at different spot prices of the underlying share. The second table shows the net gain loss from the short call and the long share at different spot prices. As could be seen, delta hedging is dynamic to maintain delta neutral portfolio as the position constantly changes with change in the underlying price. Here at every stage, a delta neutral position is maintained by altering the number of underlying shares held. As delta of call option is less than 1 and security has a delta of 1, so any change in spot price brings the net position in loss during the tenure of the options, as could be seen from the above table. Thus, by maintaining a delta neutral position for different strike prices at the same point of time results in loss at most of the spot prices. Now let's see if we adapt static hedging instead of dynamic hedging in the same example. So we continue with 0.58 of the hedge ratio as adapted at the inception. In the real world, exact delta matching is rarely done as it frequently turns the position unprofitable. The objective is to earn profit, and delta hedging is a means to mitigate the risk, as delta hedging in itself is not an objective. Actually, a range profitability is targeted on expiry of the options, and the delta hedging is used to determine the width of the range. As in the previous example, if only 58 shares are carried over a spot price range of around 90 to 100, then the position remains profitable on options expiry. As shown in the table, on expiry of the call option, the payoffs from the short call and long share maintaining the same hedge ratio. As could be seen from the table in the graph, if the position of short 100 call option and long 58 underlying shares are carried on till option expiry, the position remains profitable over a spot price range of around 88 to 120, which is around one standard deviation, considering the implied volatility at the inception of 30%. Now, delta is influenced by all the variables present in D1 other than the spot price. However, other than change in the spot price, only change in implied volatility has the material effect on delta. So let's consider the multidimensionality of delta and how delta is influenced by the change in implied volatility. Vana is the partial derivative of delta with change in implied volatility. The graph below shows the changes in Vana and delta of a call option with change in implied volatility. Now the y-axis shows the Vana and the delta values, and the x-axis the implied volatility. So this has an upward sloping curve. So as the implied volatility increases, the Vana also increases. This is for a call option having the details given on the graph. As could be seen, as the Vana increases, as upward sloping curve, so delta also increases with increase in implied volatility. Now the second graph below shows the change in delta for the same level, for the same call option at different implied volatility levels. As these are the three delta values for three different delta values for the call options mentioned in the graph, having three different implied volatility levels of 20, 40, and 60%. However, the Vana grid needs to be considered for delta hedging only by market makers who deal in bulk options, as its impact is not as much as that of change in the spot price. So small investors may not consider Vana for delta hedging as its impact is not that substantial. The change in other variables present in D1 like expiry time, risk-free rate have insignificant effect on delta. So those are generally not considered. Now, what is the need for delta hedging under different situations, and what are the benefits of doing the same? The obvious purpose of delta hedging is to mitigate the directional risk of a security or portfolio of securities. As volatility traders trade in options with an objective of gaining from difference between implied volatility of options traded and the expected future realized volatility of the underlying assets. So they need to control the directional risks arising from the price movement of the underlying assets under control. The directional traders following the long and hold investment strategy also need to control the downward price risk movement. The directional traders following short investment strategy for securities oblique commodities need to control the upward price risk movement. The market makers who sell options at a specific strike price usually hedge out some of the directional risk arising from adverse price movement of the underlying asset. The delta hedge strategy could be executed by long options, short options, or by long and short or combination of option securities depending on the needs of the situation. Now let's examine the overall benefits and limitations of delta hedging. First, the benefits. The biggest benefit is it can mitigate the loss arising from the adverse directional movement of the underlying asset. The static delta hedging strategy could reduce losses from the outlier movements of the underlying asset. The dynamic delta hedging strategy could significantly reduces the adverse price movement risk at all price levels. Delta hedging is useful not only in the securities market, financial securities market, but is highly useful in other asset markets like commodities, currencies, etc. Now let's examine the limitations. Delta hedging is an associated transaction cost. Dynamic delta hedging is difficult to execute in real world, plus is quite expensive. Especially dynamic delta hedging is quite expensive in the long term. Delta hedging eats into the profits of the portfolio as it is quite expensive. Sometimes it is difficult to find appropriate offsetting replicating assets which could be used as a hedge. Static delta hedging loses its effect during strong price movement of the underlying asset. So this concludes the presentation. Thanks for watching.